In this chapter, we're going to learn about accounting. We won't be working with debits and credits, but instead understanding the process and working with the end result, the financial statements. Accounting is the process of measuring, interpreting, and communicating financial information to enable people both inside and outside the firm to make informed decisions. Here we see the many users of accounting information and what they use the information for. Stockholders and potential investors want to know if buying stock in your company is a good investment. Lenders and suppliers want to see if they should lend you money. As we'll see towards the end of the chapter, ratio analysis is a way for these groups to answer their questions. The government is interested in seeing how much you owe them in taxes. Managers are the major users of accounting information and use that information to plan and control. For instance, do we have enough money to fund a new project? To help employees understand how their work affects the bottom line, some companies practice open book management. Open book management is where sensitive financial information is shared with employees, and they're shown how to understand and use these financial statements. The goal is to show employees how their work contributes to the company's success. Accountants can be classified as public, management, government, or not-for-profit accountants. Public accountants provide accounting services to individuals or businesses for a fee. The three basic types of services they provide are auditing, tax preparation, and management consulting. Due to the inherent conflict of interest associated with providing auditing and management consulting services to the same firm, legislation now limits the types of consulting services auditors can provide. Management accountants are employed by a business other than a public accounting firm. They collect and record financial transactions, and they prepare the financial statements for the business they work for. Government and not-for-profit accountants are similar to management accountants, but they work for either federal, state, or local governments or for not-for-profit organizations. Certified public accountants, otherwise known as CPAs, are accountants who have met specified educational and experiential requirements and have passed a comprehensive examination on accounting theory and practice. There are other certifications that accountants can get, such as a certified management accountant or a certified internal auditor. Now let's talk about the foundation of the accounting system. Generally accepted accounting principles, otherwise known as GAAP, are the principles that encompass the conventions, rules, and procedures for determining acceptable accounting and financial practices at a particular time. They're based on the four basic principles of consistency, relevance, reliability, and comparability. Accountants follow GAAP in order to provide reliable, consistent, and unbiased information that is used by decision makers both inside and outside of an organization. So what does this mean? This means that the banker, the supplier, the investor doesn't need to understand all the ins and outs of your business to make sense of your financial statements, because your financial statements have been constructed in a way that is comparable to other businesses. They can see your profit margins, your debt ratio, how liquid you are, etc. This is extremely powerful. Lastly on this slide, the Financial Accounting Standards Board, otherwise known as FASB, is responsible for evaluating, setting, or modifying GAAP. The Sarbanes-Oxley Act of 2002 established the Public Company Accounting Oversight Board. This was in response to well-known cases of accounting fraud and questions about the independence of auditors. This is a 5-member board created to set audit standards and to investigate and sanction accounting firms that certify the books of publicly traded firms. Part of this act requires that senior executives, including the CEO and CFO, must personally certify that the financial information reported is correct. Let's take a look at the actual accounting process. The accounting cycle are the activities to convert information about individual transactions into the financial statements. Every day transactions occur, such as ordering supplies, paying bills, recording sales, receiving payments, and paying employees. These are first recorded chronologically in journals. These individual entries are then posted to ledgers. Ledgers are used to prepare the financial statements. This slide shows 4 financial statements: the balance sheet, income statement, statement of owner's equity, and statement of cash flows. Here is the accounting equation. Assets equals liabilities plus owner's equity. A couple of years ago, a student pointed out that the letters spelled aloe. Assets, liabilities, owner's equity. I share this with you so it may help you remember the equation. Assets are anything of value owned or leased by a business. Liabilities are any claims against a firm's assets by a creditor. Owner's equity are all the claims of the proprietor, partners, or stockholders against the assets of the firm, equal to the excess of assets over liabilities. As we'll see in a few slides, the balance sheet follows the accounting equation. The accounting equation states that assets must equal liabilities plus owner's equity. This equation reflects the financial position of the company at any point in time. This equation also illustrates double entry bookkeeping. How we record accounting transactions. Each transaction has an offsetting transaction. Let's look at a few examples. For the first one, the example is the owner of a company purchases a new camera system for $5,000 using personal funds. Well, if we look at the equation, assets equals liabilities plus owner's equity, the equation always has to balance. So we see that the new camera system is the asset. Adding that asset to our company increases our assets by $5,000. The other effect it has, the offsetting transaction, is that owner's equity has gone up by $5,000 because the owner brought in personal funds into the company. Let's look at another example. In this one, we purchased $400 of inventory using trade credit. So our assets, meaning our inventory, has gone up by $400. So we need an offsetting transaction that will balance this equation. Well, trade credit, this is credit that's been extended to us by our supplier, has gone up by $400. We now have something we have to pay, so our liability has gone up by $400. In the next example, we see that we're paying our employee salaries for payroll. Payroll is paid with cash, so our asset cash has gone down by $400. Our liability, salaries payable, has also gone down by $400. With double entry bookkeeping, regardless of the transaction, there is always an offsetting transaction that maintains the equality of this equation. Computers and web-based products have simplified the accounting process. It is now easier and simpler than the manual method that was used before. Okay, on to the financial statements. First, we'll talk about the balance sheet. The balance sheet is a statement of the firm's financial position, what it owns, and the claims against its assets at a particular point in time. It's similar to a photograph of the firm's assets together with its liabilities and owner's equity at a specific moment in time. Here's an example of a sample balance sheet. As we can see, in Section 1, we have our current assets. These are cash and other liquid assets that can or will be converted to cash within 1 year. That differs from our long-term assets, which are demonstrated here in number 2 and described as plant, property, and equipment. These are expected to last for more than a year. Also included in our total assets are goodwill and other intangible assets. And as you'll see, our total assets here are equal to our total liabilities and owner's equity down here. Now let's look at the second half of this balance sheet. Our current liabilities, listed here in number 4, are the claims of creditors that have to be repaid within a year. That differs from our long-term debt, which lasts longer than a year. And then lastly, we have our stockholders' equity or owner's equity down here. Again, note, total assets equals our liabilities and owner's equity. It's the balance sheet and it follows the accounting equation. Now let's look at the income statement. The income statement is a financial record of a company's revenues, expenses, and profits over a period of time. Here's an example of an income statement. As we can see, we start out with our sales here. These are the revenues or funds received from the sale of our goods and services over a period of time. We subtract out all our expenses. First, we subtract out the cost of those goods we sold or services. That gives us our gross profit. Then our operating expenses, which include our salaries and other operational expenses, are subtracted, giving us our operating profit. Here we subtract out depreciation. Please note this is a non-cash expense. We get to deduct it, but we don't actually pay it out. It's a non-cash expense. Then we have our interest expense, our earnings before taxes, and then finally our income taxes, leaving us with our bottom line or our net income. A third financial statement is the statement of owner's equity. This is designed to show the components of change in equity from the end of one fiscal year to the end of the next. It begins with the amount of equity shown on the balance sheet. Net income is added, and cash dividends paid to owners are subtracted. Here's an example that you can look at. Lastly, we'll look at the statement of cash flows. I want to briefly describe this statement to illustrate the concept of accrual accounting. As a result of accrual accounting, there can be differences between what is reported as sales, expenses, and profit, and the amount of cash that actually flows into and out of a business during a period of time. With accrual accounting, this accounting method records revenues and expenses when they occur, not necessarily when the cash changes hands. So if I order or place an order for supplies in January, but they come the end of January, early February, and with the delivery comes a bill for me to pay in March or April, I don't wait till I pay that bill to record the transaction. I actually record the transaction when I place the order. So that would be recorded in January. The statement of cash flows provides investors and creditors with relevant information about the firm's cash receipts and cash payments for its operations, investments, and financing during an accounting period.